Happy morning, students. So today we are ready with the new questions, and this is of chapter Sources of Business Finance. So here we are going to see a particular situation and what is the solution we have to suggest by looking over the condition. So let's move out with the question. The question is, ABC Limited is an auto spare part manufacturing company. So that means ABC Limited is a company and it is a public company because the word private limited is not written. The word only limited is written after the name of the company. Okay. So it is a public company. Let's move the further. The company has issued equity shares and preference share to meet its requirement. The company is having the opportunity to issue equity shares and preference shares, and they are having ample scope of raising the fund from various sources. They can go for loan, they can go for public deposit, they can go for factoring, lease financing, trade credit. Various options are there. But here in this case, this ABC Limited has opted for two main sources, that means equity shares and preference shares, which is related with the owned capital. Okay. Now, this has resulted in payment of large amount of taxes as dividend on shares is not deducted for the purpose of tax calculation. Yes, we know this fact. Whenever we are paying tax, the dividend is not at all deducted as an expenses. Yes, the interest which we are paying on loan or debentures or on public deposits, that will be calculated as an expense of the company and it will be deducted from the total revenue to earn profit. The result will be that whatever profit is earned, on that only the tax will be calculated. But when we are giving dividend to shareholder, the problem is that dividend is actually allocation of profit. We are sharing profit, but it is not a burden on profit. It is not reducing the profit. It is just allocation of profit. That is why dividend is not deducted, and the result will be that we have to pay high interest because profit will be high, and if the profit is high we have to pay high tax. But when the profit is low, we have to pay low tax. So here in this condition, we have seen that ABC Limited has issued equity shares, preference shares, but it has not taken any type of loan. It has not gone for the public deposit even. So it is not at all paying any interest, and the result will be that profit will show very high in the account and it has to pay high tax on that. Now what they are asking, state the source of finance which can give benefit of tax saving. So what are the sources there? As we are discussing right now, we have seen loan. If we take the loan from the bank or the financial institution, we have to pay interest, and interest will be treated as an expenses which will reduce profit, and on reduced profit we have to pay less tax. So one of the option which is available is loan. Another option is debentures. We can take loan from the public, and this can be via debentures also. We can issue debentures and public will invest their money, and later on after a specific period we have to return the money to the public. So this is what we are calling debentures, and on debentures the company has to pay interest, and this interest will again reduce the profit. So debentures, if we want to save tax, we can go for debentures. And one more option is there, that is public deposit. That means if public is depositing their money in our company, we are having the option to pay the interest. Obviously we have to pay the interest, because when the public has deposited their money, they are expecting a good interest from us, and then again that interest will be taken as expenses. As a result, the profit will be reduced because that is an expense, and finally we have to pay the less tax. So the other options which are available in front of ABC Limited, they can go for loan, they can go for debentures, they can go for public deposit also. So many sources are there. And now to clarify the answer, I just want to show a very small mathematical calculation so that it will be easy for us to understand how it is finally arriving, how this conclusion we can say that interest can reduce the tax burden. You see here, for example, there are two conditions, first condition and second condition. In the first condition, the company is issuing debentures, and in the second condition, the company doesn't issue debenture. Instead of that, it is issuing more shares. Okay. Now, all the calculations we are going to do in rupees only. I'm taking a very small amount. Okay. Suppose initially the total number of shares in both the cases was 10. Okay. Initially it was only 10. So total number of shares in the first case was 10 and second case again it was 10 only. Okay. Total revenue in both the cases is 100 rupees. I'm taking very small amount so that it will be easy for us to understand. Total revenue is 100 rupees. Now, if I talk about expenses, all the general expenses of the company, if we calculate, let us assume it is 50. Okay. So the expenses in both the condition is 50 only. So it is, if we deduct it, what we will get? 50 rupees as a profit. So this is profit before we pay any type of interest. And we have seen that in the second condition, the company is not issuing any type of debentures. It is not taking any type of loan. As a result, this is the final profit of the company. Okay. And here in the first case, the company is actually issuing the debentures and it has to pay tax. Suppose in both the condition, the thing is that in first case, company is issuing 5 debentures. For example, 5 debentures. And in the second case, the company is issuing 5 shares. Okay. So initially it was 5 shares. Now plus 5. So total 15 shares. And here 10 shares and 5 debentures. Okay, two different things are there. Now when we have issued the debentures, we have to pay pay interest. So suppose here in the first case, the interest which we have paid on the debenture is rupees 10. So this is the final profit on which we have to pay the tax. Okay, this is the final profit on which we have to pay the tax. Now see here the difference only. Suppose the tax percentage is 10. We are paying 10% tax. So how much we are paying in the first case? 10% of 40 is just 4. And how much we are paying in the second case? 10% of 50 is 5. So look here, there is one of the thing we have seen. Only by issuing debentures we can reduce the tax burden. Earlier it was, in the second case we have to pay 5, while in the first case we have to pay only 4. So here only we have reduced the tax burden. So here in this case, 36 is the amount which has to be distributed among the 10 shareholders in form of dividend. So just make a calculation. 36 by 10, that means every shareholder will get 3.6 rupees or 3 rupees 60 paise as dividend. This is the first condition. Now see the second one. 45 is the money which is left after payment of taxes. Now this condition, this 45 has to be divided among 15 people now. And what we are getting? 3 only. So here what we have done? We have paid more tax and we are paying less dividend. So this is what they wanted to say through these questions. According to this question, they have asked that what are the sources through which we can raise the fund and it will help us to reduce the tax burden. So yes, we can go for debentures, we can go for loan, we can go for public deposit, and we can pay interest, and it will help us to reduce the tax burden. Okay, so I hope the question is clear via the explanation, theoretically as well as the numerically. Thank you. Have a nice day.